Well, hello, everyone. Hello, and thank you so much for coming tonight to the Benjamin Z. Miller Investor Networking Group. It's a pleasure to see everyone. Tonight, we have a very interesting and important topic we'll be talking about, and that is currency trading. We're going to, in this presentation, talk about one of the most famous, arguably the most famous currency trade of all time, which was done by George Soros with where we'll go through that in a bit more detail, but it's a very famous trade. And we'll also talk about what drives the currency to appreciate and what causes it to depreciate against another currency, and how you can make some accurate predictions, not in the short term. I'm not talking about making predictions in the short term, but if you're talking about the long term, you can make pretty accurate predictions if you're making predictions that are maybe more than a year or two into the future, which direction the currency is going to be going. So I'm not suggesting this will work for predicting a week from now what'll happen, because so much of that is driven by the news and other factors. But these are the economic fundamentals that actually move a currency, and we'll be talking about that. So let's start out by talking about the famous trade by George Soros, which was in the year 1992. And this trade was $1 billion trade. Actually, with this trade, what happened was on the 16th of September, 1992, the United Kingdom government, they actually had to withdraw their pound sterling from the European exchange rate mechanism. So George Soros and his fund made a tremendous amount of money, as did some other investors, Paul Tudor Jones of Jones Investments. It was really a remarkable trade. And we'll watch an excerpt here that kind of goes through the history of what happened on that trade.
You may not know what SSL is, but hackers do, and they hate it. SSL helps protect your site.
George Soros, a man shrouded in political controversy, and yet one of the most successful investors of all time. While many today are familiar with his political endeavors, there is a much more interesting story that has, in comparison, avoided the public spotlight. In this video, we're going back to the decade before the euro, where the Wild West of European currencies allowed George Soros to almost break the Bank of England and to make $1 billion in the process. This video is brought to you by Skillshare. Watch my classes on how the stock market works for free. Exchange rate mechanism, or ERM, sounded good on paper and did make things easier for a lot of people. But it also made the national banks of these countries very vulnerable. You see, people buy currencies every day in vast volumes to fund imports or exports, and these transactions have a significant effect on the actual exchange rate you can get from the market. So once a country becomes a part of the ERM, it had to constantly monitor the markets and intervene if their exchange rate started to deviate too much. If too many people were buying, the national bank would start to sell. And if everyone was selling, it would go into buy. Without going into too much detail, the ERM was flawed because every country is unique. It has to constantly balance interest rates, inflation, and economic growth, which it cannot do if its currency is artificially chained to others. Margaret Thatcher, the Prime Minister of the UK at the time, understood this very well, which is why she opposed it and why Britain wasn't a part of the ERM when it first began. However, as the British economy worsened towards the end of the 1980s, Thatcher's Eurosceptics lost ground to more pro-European members of the Conservative Party. By October 1990, Thatcher's power had diminished so much that Britain joined the ERM despite her opposition, thanks to the political power of John Major, the Chancellor of the Exchequer at the time. Less than a month later, Thatcher had resigned, and Major was selected as Prime Minister, hailing the ERM as his victory.
All my adult life, I've seen British governments driven off their virtuous pursuit of low inflation by market problems or political pressures. I was under no illusions when I took Britain into the exchange rate mechanism. I said at the time that membership was no soft option. The soft option, the devaluers option, the inflationary option, in my judgment, that would be a betrayal of our future at this moment. And I tell you categorically, that is not the government's policy.
But while November 1990 might have been the start of a very successful political career for John Major, it was just the beginning of Britain's economic problems. You see, when the UK joined the ERM, it was already in a recession. Now, when an economy is in a recession, the central bank, in this case the Bank of England, wants to cut interest rates to prop things up. But because of the ERM, it could no longer do that. The British pound was already a very weak currency, with the UK's inflation rate being 3 times higher than Germany's. If the Bank of England cut rates, it would help the British economy, but it would devalue the pound so much that Britain would have to leave the ERM, which of course John Major would never allow. And so between 1990 and 1992, the British economy suffered. Of course, just keeping interest rates high wasn't enough to maintain the pound's value. And so throughout these 2 years, the Bank of England would frequently go to the market and start buying up pounds by the millions, using up its foreign exchange reserves in the process. Even that didn't really help though, since the pound continuously weakens during this time, just barely within the limits of the ERM. Pretty much every currency speculator understood that eventually the British pound would have to devalue. But the billion-dollar question was, when would that happen? The man with the answer was George Soros. He had been running his hedge fund since the 1970s, and his specialty was predicting and sometimes forcing the catalysts to big market events. He knew that almost everyone was ready to bet against the British pound if only there was some sort of bad news that could trigger a stampede big enough to overwhelm the Bank of England. Starting in August 1992, Soros and his fund began building a position against the pound, and here's how he did it. He'd go to a big bank or another hedge fund and he'd borrow pounds from them with the promise of repaying them with some interest on top. Then he'd go to the foreign exchange market and he'd sell those pounds to buy German marks instead. The idea being that when the exchange rate drops, he'd be able to buy back those pounds cheaper, earning the difference as a profit. By the end of August, Soros had slowly built up a position equivalent to $1.5 billion against the pound. But the exchange rate had barely moved. He needed some sort of news to really start increasing his position. And luckily for him, on September 16th, the president of the Bundesbank held a seemingly innocent interview that Soros could nevertheless use. The Bundesbank president said that he doesn't rule out that some currencies might come under pressure, which in and of itself is a very vague and unconvincing statement, but Soros decided that it was good enough for him. That same night, while Europe was asleep, Soros called up any international bank or company, or really anyone that had British pounds, and he tried to borrow them with great success. By the time the British woke up, Soros had sold the equivalent of $10 billion worth of pounds on the open market. Unsurprisingly, the Bank of England was in complete chaos. After an emergency meeting with John Major, the Chancellor of the Exchequer began a desperate fight. At 8:40 a.m. on September 17th, he authorized the purchase of £1 billion from the market to no effect. By 9 a.m., he had purchased another £2 billion, at which point he dialed John Major again to request permission to increase the interest rate, which of course, because Britain was in a recession, would be devastating to the economy. Initially, John Major refused because he thought it would be political suicide. But as Soros and the global currency market continued selling pounds, by 11 a.m., Major conceded, and Britain made a surprise announcement that it was increasing its interest rate by 2%, which is a very big increase. By the end of the day, Britain had purchased £27 billion and had increased its interest rate a second time to 15%. But just Soros alone had sold about half as many pounds, and by that point, the entire world was following suit. At 7:30 p.m., the British government accepted defeat with the following news conference.
A unique day in London's financial markets ended with the Chancellor announcing that the pound was being suspended from the ERM, and that the second of two dramatic interest rate rises during the day was after all cancelled.
Today has been an extremely difficult and turbulent day. Massive speculative flows have continued to disrupt the functioning of exchange rate mechanism. As chairman of the Council of European Finance Ministers, I have called a meeting of the Monetary Committee in Brussels urgently tonight to consider how stability can be restored to the foreign exchange markets. In the meantime, the government has concluded that Britain's best interest is served by suspending our membership of the exchange rate mechanism.
Over the next few days, as the foreign exchange markets were left to their own devices, the British pound fell by 15% against the German mark and by 25% against the US dollar. Soros and his fund pocketed a nice $1 billion from their trade, while the estimated cost to the British taxpayer was over £3 billion. Here's the funny thing though. In the aftermath of Black Wednesday, as they called it, the Bank of England was once again free to control the British pound, which it did, and over the next few years it steadily cut interest rates and actually restored the British economy to high levels of growth. By 1997, the British pound was actually more valuable than it had been during the ERM, and the UK was on its way to 16 consecutive years of economic expansion, so much so that some people actually call that day White Wednesday. So in the end, Soros might have actually done the British a favor, even though he pocketed about $15 for every man, woman, and child in Great Britain. Now, if you enjoy learning.
Okay, excellent. That is such a great example of a currency trade. It's a very famous trade, but what actually drives the currency exchange rates? Well, at its most basic level, you have a good economy and you have a bad economy. And in general, a good economy, the currency increases in value relative to the bad economy. Since currencies are always paired, the performance is determined relative to the other currency. So now let's take a look at a very important agreement, the Bretton Woods Agreement, which happened in July of 1944 towards the end of World War II. This was an agreement where 44 countries, they coordinated and they agreed to set exchange rates after the end of the war. So at the time, the British pound, one British pound back in 1945 would purchase $4 US. But over time, eventually what happened was the exchange rate was allowed to move, and over time, the British pound weakened against the US dollar. But it's interesting to look at the movement, because back in 1945, one British pound would purchase 4 American dollars. And as of the 1st of January 2023, one British pound will only purchase $1.20. So if one has British pounds, they have gone through quite an experience as a result of that. And one other factor that came into play was that Bretton Woods actually ended in 1971, and the dollar was removed from the gold standard in 1971. Back then in the United States, the Vietnam War and the trade deficits were putting a lot of pressure on the US dollar, and it led to the flow of dollars out of the United States. So at the time when there was the gold standard, they had set the dollar where US dollars could be converted into gold at the rate of $35 per ounce. However, the real market rate was different than what had been set. And as a result, other countries, in particular the French Central Bank, they started to buy, they would buy US dollars with French francs, and then they would request that the dollars be converted into gold, and then they would actually ship the gold out of the United States to France. So it was a very interesting move on their part, and they got a lot of gold. So that's once they removed the gold standard, that is when you saw a tremendous increase in prices in the United States. So Nixon terminated the US dollar being on the gold standard back in 15th of August, 1971. And when that happened, we see here a massive cost of living increase. If you were to go back to the year 1971, well, you could buy a brand new house for $25,000. You could buy a new car for $3,500. The average rent was $150 a month. And if you look over here at the graph on the right, you see the consumer price index. And look back in 1775, around the time of the Revolutionary War, look at the War of 1812, look at the Civil War, look at how stable that CPI was. That consumer price index was very, very stable. Then when World War I started, it went up a bit. When World War II started, it went up a bit. But look at what happened as soon as they removed the gold standard back in 1971. That is when you got massive increases in price, just absolutely massive. So now let's talk about inflation rates, because inflation rates, they have an impact on currency exchange rates. And the way to think about inflation is if you have two different countries and you have one that has a higher rate of inflation than another, the country that has the higher rate of inflation, its currency is going to go down lower. Now, that's not the only factor that's going to determine the exchange rate. The inflation is one of several factors, but it's an important factor. So when you're trying to make a decision on which currency is going to get stronger and which is going to be weaker, you can look at the exchange rate of the two different countries. Now, that'll give you one indicator of what's going to happen in the future, but you have to look at more than just the rate of inflation. But the rate of inflation is very important. You can see here, some inflation rates around the world. Floating exchange rates. This is something where you see after they ended the Bretton Woods system, most of the major currencies, they simply float against each other in value. Now, there are a few currencies that are still pegged, but you see a lot of movement here. And I really like the example of the British pound and the US dollar because it's such a movement. So what's another thing that will make a currency appreciate or depreciate? Well, expectations about future exchange rates. So if people look at that, they look at the inflation, the economic performance of the country. Countries that are strong economically, they tend to see increased demand for their currency. So if you look at a country like maybe Zimbabwe, where it's not strong and where it has high inflation, that makes people not want to really have that currency. Whereas if you look at a currency like say Germany, that currency has a much lower, you take the euro as an example, or you take whatever, these things all have an impact there. So here's an example of, this is the Syrian Central Bank. They actually devalued their local currency. This was recently because they had a lot of currency speculators and they were trying to discourage speculation in the currency, but it's rather interesting. Here's another example. Debt levels have an impact on a currency. So if you have a country that runs higher debt levels, the larger the debt in relation to the gross domestic product, that is going to make that currency less attractive to foreign investors, and it translates to lower demand for a currency. Another thing is the balance of trade. So the balance of trade is the difference between a country's imports and exports. So if you have a country that has a positive balance of trade, where they are exporting more than they're importing, a good example would be China. They export so much. And the US very often has the opposite, where we import more than we export. But this flow of currency, the balance of trade, is a factor that has an impact on the exchange rate. So in 2021, the US traded 5.9 trillion with foreign countries, and that consisted of 2.5 trillion in exports, which sounds like a lot, but the imports were 3.4 trillion. So a huge deficit there, where we're importing in the United States significantly more than what we're exporting. And that is something that represents a challenge to the currency. But right now, the US dollar is actually doing quite well. That's for some other factors. But printing lots of money, of course, that depreciates a currency. I love this illustration here that shows the inflation rates in Zimbabwe. Look at this. This guy has 100 billion and he can buy 3 eggs. 100 billion. That is just really something. And you can see, back here, all of a sudden, something happened around this time. I wonder what happened. Well, if you research the history of Zimbabwe, I won't go through it here, but you can definitely see that right around this time, there was something that happened that had a major impact on the exchange rate. Let's talk about an increase in the interest rate. So let's imagine that you have someone that has a lot of money in a bank account somewhere in a particular country. And let's say that they have several million in a bank account. And in their country, they can earn 3%. But they have a friend or they know someone that's in Mexico, and they find out that, hey, in Mexico, you can get 12% interest. And that sounds a lot better than 3%. So they call up a bank in Mexico and they say, hey, I hear you got 12% interest rate. I've got money in an account over here, and I've got, for example, US dollars, and I want to put my money in the bank over here. And the banker in Mexico, he says, well, sure, you can put your money in. We'd love to have you as a customer, but we need you to put it in as pesos, because we're paying 12% on a peso denominated account. We're not paying 12% on a US dollar denominated account. So what happens is the saver will go into the foreign exchange market where they will actually trade, they'll agree to trade the dollars for pesos. And you have an initial supply and demand, which you can see here in the chart on the right. So this is say the US dollar exchange rate. It has a certain equilibrium at the beginning, but the effect of when you actually do this trade, the exchange rate moves. So it creates more demand for the peso as a result of that. The point is that the interest rates, they're directly correlated, where it shows what people will, a higher interest rate in a particular country makes people globally in general want to earn that higher rate of interest, and that increases demand for that currency in general. So what about a recession? You know, we hear all the time in the news about a recession. Well, when a country has a recession, basically the government, their favorite thing to do when there's a recession is they want to stimulate the economy. So the government does this in most countries by interest rates, where what they will do is they will actually change the interest rate. They will buy or they will sell bonds in that country through central bank stepping into the market. So the capital starts to go through. So let's imagine that the US enters a recession and say that the interest rates are lowered by the Federal Reserve. So there's a recession, it's not a good economy, and there's a decision made that we need to lower the rate of interest, and the Federal Reserve would do this. And when the interest rates are lowered, the banks are paying people less on their deposits. And what that does is it makes some people that might have dollars in the bank decide, you know what, I'm gonna get out of here. I'm gonna go over to the United Kingdom where I can get, for example, a higher rate of interest. This is hypothetical, but you know, this shows you how it has that impact. But it's one of many factors where it basically implies a lot of different things going on. Here's a great chart. This actually shows the US dollar, Ukrainian hryvnia exchange rate. And we're going to look at this over time. So the National Bank of Ukraine, they set the official exchange rate of the hryvnia against the US dollar, where they set it at 36 hryvnia to the US dollar. They did this back on the 21st of July, 2022. And if you look at the chart here, you can see, hey, oh, wow, here we are right there on the 21st of July. All of a sudden, that policy decision was made, and the exchange rate went from a market-driven rate, which was a little bit less than 30, to now all of a sudden the exchange rate is higher. So the official hryvnia dollar exchange rate, it remains fixed. And basically under this is a result of the war, where there was a decision made to intervene in the foreign exchange market. So they have made a one-time change in the exchange rate. But when you see a situation where an exchange rate is being maintained artificially instead of by market forces, that can often build up over time, where it tends to go back in the direction of the market. So here we have some terminology that's important for currency trading. This is something that is important to know about. So there's what's a base currency and a quote currency. So there's also what is called a point or a pip. A point is a fourth unit after the decimal point, which is the smallest unit of an exchange rate. And then there's the spread, which is just looking at the difference between the bid and the ask price. And you will find that some currencies, for example, the euro and the US dollar, or the British pound sterling and the US dollar, these have a very tight spread. The smaller the spread, the more liquid the currency. Whereas if you were to take another currency pair, like, for example, some small African country and the US dollar, there's going to be, there's not going to be as tight a spread. And that's just something that to move into and out of the currency, there's a bit of a spread there that has to be factored in. It's not that important for long-term trading, but a lot of short-term traders, they are really fixated on that because they like to move in and out of positions instead of try to do the economic style trading where you're looking at longer term what is going to happen, because longer term you can make pretty accurate predictions about what's going to happen, but it's not something where you can easily turn around and, hey, I'm going to buy this and I think 2 or 3 months from now this is going to happen. That's real hard to do. It's hard to predict. There's a lot of factors that come into play, but it's important as an investor to be aware of what impacts a currency. It's important to be aware of all of this because it can definitely help you. And the other thing that I think is really important to consider is if you do real estate investing, right now, for example, if you look at the United Kingdom and the United States, well, the US dollar has a lot more power in terms of it has appreciated a great deal against the British pound. So it's an ideal time to acquire real estate in, say, the United Kingdom using US dollars. So if you have a portfolio of property, say you have a portfolio of assets and you start cash out refinancing those assets, you can get a lot of US dollars. And then you could go and you could deploy that into purchasing assets in the United Kingdom, but you get some advantages because right now the US dollar is so strong, the US dollar has more buying power. So that is the presentation for today. So I'm going to go ahead and I'm going to just open it up to any questions, and I welcome any questions about this. I'll be happy to answer any questions that anyone might have. I'm going to go ahead and start up the recording now.